Every country loves to say its money is strong, its future is secure, and its economy is built on solid foundations. But in 2013, Japan did something very few wealthy nations ever do openly. It admitted, without saying it directly, that sometimes strength becomes a weakness, that sometimes the only way to survive in a global system is to deliberately make yourself look weaker. That year, Japan decided to crush its own currency on purpose. The yen fell. The stock market soared. Exporters cheered. Headlines called it a bold new strategy. Analysts gave it a respectable name, Abenomics. But beneath the respectable language, something much older was being resurrected, an ancient game that empires have played for centuries. Why would one of the richest nations on earth intentionally make its currency worth less? Why would a country that had earned a reputation for safety and stability suddenly decide to shock the world with aggressive money printing? And maybe the most uncomfortable question of all, if Japan did it first, who was really far behind? To understand the yen shock of 2013, you can't just look at a single year. You have to zoom out. Because money printing as a form of competition isn't a Japanese invention, it's a historical pattern. In the late Roman Empire, emperors faced a familiar problem. Wars were expensive. Maintaining legions was expensive. Feeding cities was expensive. Raising taxes was unpopular and risky. So they did something easier. They took their silver coins, shaved off some of the metal, mixed in cheaper metals, and stamped new coins. On the surface, nothing changed. The coin still had the same symbol, the same emperor's face, the same name, but there was less real value inside. That was their version of money printing. In the 1500s, Spain discovered the silver of the New World and flooded Europe with it. For a time, it looked like incredible wealth. But as more silver entered circulation, prices rose. Wages struggled to catch up. The people closest to the source of new money, courtiers, merchants with royal connections, insiders, benefited first. Everyone else adjusted later. Wealth didn't disappear. It moved. In the 1930s, after the Great Depression, Britain, then the United States, and eventually many other countries abandoned the gold standard. By cutting the tie between their currencies and gold, they gained a new freedom, the ability to devalue. They didn't present it as devaluation. They called it recovery, flexibility, monetary adjustment, but the effect was simple. Their goods became cheaper to the rest of the world, while other nations were forced to suffer the consequences. The pattern is clear. When an economy slows, when debt piles up, when exports weaken and growth refuses to return on command, leaders look for a pressure valve. Sometimes they call it reform. Sometimes they call it stimulus. Sometimes they call it extraordinary policy. Almost always, it involves making money easier to create and cheaper to hold. By the time we reach Japan in the early 2010s, the stage is already set. Japan had gone through what economists politely call the lost decades. After its bubble burst in the early 1990s, the country slid into a long period of stagnation. Not a dramatic collapse, not a sudden depression, something more subtle and more stubborn. Years and years of low or no growth, falling or flat prices, and a heavy, immovable mountain of public debt. Deflation isn't just low inflation. It's the slow-motion erosion of confidence. Prices drift lower. Wages don't rise. People delay spending because things might be cheaper later. Businesses hesitate to invest. Debt becomes harder to pay back because the money you owe is worth more in real terms over time, not less. Economies are not built to thrive under deflation. They suffocate. Japan faced all of this at once. A shrinking and aging population, gigantic government debt, a strong yen that made its exporters less competitive abroad, and a global environment where any sign of crisis elsewhere drove investors into the yen as a safe haven, pushing it even higher. In other words, every time something went wrong in the rest of the world, Japan was punished for being stable. By 2012, the situation was unsustainable. The country needed growth, it needed inflation, it needed a weaker currency, and it needed all of these things fast. When Shinzo Abe returned to power, he brought with him a three-arrow strategy: aggressive monetary easing, flexible fiscal policy, and structural reforms. The first arrow is the one that shook the world. The Bank of Japan, under new leadership, announced it would flood the system with newly created money, buying assets at an unprecedented scale. They didn't just whisper about inflation. They declared a target 2%. On the surface, that sounds harmless. 2% doesn't sound radical. But when a central bank commits to printing until it hits that target, it sends a message to every trader, every corporation, every investor on Earth. The value of this currency is going down. And that's exactly what happened. The yen plunged against the dollar and other major currencies. Suddenly, Japanese exporters could sell their cars, electronics, and machinery at a more attractive price. Profits improved. The stock market surged. Corporate earnings looked stronger. For a while, Japan seemed to have discovered a shortcut out of stagnation. Weaken your money, boost your markets, revive your confidence. But nothing in finance is free. Once you weaken your currency, someone on the other side is paying the price. A weaker yen makes imports more expensive. That means higher prices for energy, raw materials, and foreign goods. Households feel it in their cost of living. Savers feel it in the quiet erosion of their purchasing power. The value of cash in the bank doesn't change on the screen, but what that cash can buy begins to shrink. This is the hidden tax of inflation and devaluation. It doesn't arrive as a bill in the mail. It arrives as a slow, steady rise in prices, a sense that life is getting a little more expensive, that your savings don't stretch as far as they once did. So why did Japan do it anyway? Because in the world of sovereign debt, a little inflation is a powerful ally. When a government owes enormous sums, the easiest way to make the burden lighter is to let inflation nibble at it year after year. The numbers on the debt remain huge, but in real terms, in the purchasing power of the money used to measure it, the weight is slowly reduced. You don't pay the debt back with stronger money. You pay it back with softer money. Seen from this angle, the yen shock wasn't just about exports or markets or consumer prices. It was about survival inside a system that rewards those who are willing to sacrifice the value of their currency in order to keep the machinery of debt spinning. The interesting part is what happened next. Not in Japan, but everywhere else. When one major economy weakens its currency, it puts pressure on its trading partners. If Japanese goods suddenly become cheaper because the yen has dropped, what happens to South Korea, whose companies compete directly with Japanese firms? What happens to Germany, selling cars in the same markets? What happens to China, with its own export machine? They face a choice. They can accept losing some competitiveness, or they can respond, and usually they respond. In the years around 2013, it wasn't just Japan engaging in extraordinary policies. The United States kept interest rates near zero and continued large-scale asset purchases. The European Central Bank slowly drifted into its own version of quantitative easing. Many other central banks intervened to manage their exchange rates, whether openly or indirectly. Nobody wanted to say currency war out loud, but the logic was the same. If you don't play, you lose. Japan's honesty made the dynamic visible. The country stood up and essentially said, "We are going to print to compete." Other countries didn't condemn them. They understood. Because they were doing versions of the same thing. If all of this sounds familiar, it's because history has shown this strategy before. In the 1930s, as economies struggled to recover from the Great Depression, nations began to devalue one after another. They called it beggar thy neighbor. Make yourself better off by making others worse off. In the short term, it can work. In the long term, it breeds resentment, instability, and a race to the bottom. When the United States closed the gold window in 1971, ending the Bretton Woods system, it was another turning point. The dollar was no longer convertible into gold. It became a pure fiat currency. This allowed far more flexibility, another word for a controlled devaluation. The burden of adjustment could be shifted. Inflation in the 1970s was the cost. In each case, the core idea is the same. When there's too much debt, too little growth, and too much political risk in telling the truth, countries resort to manipulating the value of their money. Japan's yen shock fits perfectly into this pattern, just dressed in modern language. So what does this really mean for the people living through it? For corporations that earn profits abroad and bring them back in yen, a weaker currency boosts reported earnings. For exporters, it's a gift. They can undercut competitors or enjoy higher margins. For the stock market, which loves rising profits, it often looks like a miracle cure. But for ordinary citizens, the story is different. If your income doesn't keep up with the rising cost of imported goods, you're slowly being squeezed. If your savings are in cash or low-yield deposits, inflation works against you. If you are retired, living off a fixed income, a weaker currency eats into your standard of living in quiet, relentless increments. Wealth doesn't vanish, it moves. It moves from savers to borrowers, from wage earners to asset holders, from those who hold cash to those who hold stocks, real estate, and claims on real things. When Japan printed to compete, it wasn't just competing with other countries. It was rearranging wealth inside its own borders. This is the part that rarely makes it into the official speeches. You hear about bold policy, fighting deflation, supporting exports, and anchoring expectations. You don't hear much about the fact that this strategy rewards those closest to the flow of new money and punishes those furthest from it. And yet, from the perspective of the system, it works. It buys time. It keeps debts payable in nominal terms. It prevents defaults that would reveal the true scale of overcommitment. It keeps the illusion intact a little longer. Japan's case also showed another uncomfortable truth. Once you start printing to compete, it's incredibly hard to stop. If you begin withdrawing support too quickly, markets panic. If you raise interest rates aggressively, the cost of servicing your own debt can explode. If you allow your currency to strengthen again, exporters complain, growth slows, and politicians feel the backlash. So you continue. You refine the policies, you tweak the language, you move from extraordinary measures to new normal, The temporary becomes permanent because the system now depends on it. The yen shock of 2013 wasn't just an event. It was a signal, a confirmation of the direction in which the global financial architecture was already moving. It told investors, businesses, and governments that aggressive monetary policy was not a last resort. It was a tool of first choice. It also raised a deeper question, one that history has asked many times before: what happens when confidence in the money itself starts to fray? For a while, people accept that central banks can print without consequence. They believe inflation will remain controlled. They assume demand for the currency will remain strong. They trust that others will continue to trust. Money is, after all, a collective story we agree on. But if that story is pushed too far, if people begin to suspect that the value of their savings is being sacrificed to keep a system afloat, trust can erode. Not all at once, not dramatically at first, but quietly. Some begin to move into harder assets. Some look for foreign currencies. Some invest abroad. Some simply stop believing in the promises made to them. History is full of moments when the story turned suddenly. Hyperinflations, currency crises, bank runs. The lesson is not that every devaluation leads to collapse. It doesn't. The lesson is that every time leaders rely on the printing press as a long-term solution, they are testing the limits of trust. And that's the real risk behind strategies like the yen shock. Not the immediate moves in exchange rates or the short-term effects on corporate earnings, but the deeper question of how far you can stretch a system built on confidence before something breaks. Japan is still seen as stable. Its markets still function. Its society remains orderly. On the surface, the experiment didn't end in chaos. But the logic it embraced, printing to compete, weakening the currency to buy time, has been echoed, expanded, and normalized by other major economies. The world is now far more synchronized in its willingness to use money creation as the first line of response to almost every problem. Crises, pandemics, recessions, geopolitical shocks. If every major economy is now willing to do what Japan did, if everyone is prepared to print and devalue when growth falters, then competition shifts to a different dimension. It's no longer about who can be sound and responsible. It becomes about who can stretch the illusion the longest without tearing it. For most people, the practical question is simple: where does this leave you? If governments and central banks around the world have quietly agreed that the easiest way to manage debt and stagnation is to soften the value of money over time, then holding your wealth only in that money becomes a bet against history. History shows that currencies are tools. They are adjusted, devalued, redefined, and sometimes replaced. What survives isn't paper promises. It's real value: productive assets, skills, businesses, and things that can't be diluted by a decision in a policy meeting. The yen shock of 2013 is not just a story about Japan. It's a snapshot of a turning point in the global mindset, a moment when one major country said out loud what others were doing silently. It showed how far leaders are willing to go to avoid deflation, default, and visible crisis. It also showed who pays the price when they choose that path. Politicians will continue to talk about strong economies, responsible stewardship, and balanced plans. They will talk about stability, growth, and opportunity. But behind those words lies a simple mechanism that history has exposed over and over again. When the pressure builds, money gets printed. When the numbers are too big to face honestly, inflation does the work in the background. When direct competition is too painful, currencies become weapons. The shock wasn't just that Japan printed. The shock was that it admitted the game, and in doing so, revealed that the old playbook of currency manipulation never really went away. It simply evolved. The modern financial system has turned money into something elastic, adjustable, and politically useful. Debt, money, and policy are now tightly fused. Devaluation isn't called debasement anymore. It's called stimulus, easing, or competitive adjustment. The question isn't whether this continues. It already has. The question is how long the story of trust can hold as more people realize what's really happening under the surface. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.